Okay, why don't we get going? And then the people who sort of drift in later, they can always get the recording for the beginning parts that they missed.
Okay.
Okay, so hi everyone, and welcome to our September Invest Smart webinar. My name is Andy Huang, Investor Relations Manager here at Break Day Capital. For those joining us for the first time, our mission is to help investors build wealth through smart multifamily investing while also focusing on education through sessions like this one. Today's topic is financial hacks for passive income. Practical strategies you can use to keep more of what you earn and grow your income streams. We're excited to have a special guest with us, Palamountain. Bromley has over 13 years of experience as a real estate investor and is an experienced financial advisor helping entrepreneurs, real estate investors, and high-earning professionals navigate complex financial strategies, build multiple income streams, and create lasting legacies. His approach goes beyond conventional strategies, bringing innovative and tailored solutions that align finances with each client's vision and values. Driven by his own journey from financial instability to empowerment, Bromley blends strategic expertise with a deep understanding of how personal history shapes financial behavior. With that, I'll turn it over to Bromley.
Awesome. Well, thank you so much for the introduction, Andy. I'm going to share my screen and get right in. I think this conversation's perfect. 90% of the conversations I have with my client base as an advisor are around being more tax conscious, either on their current tax return or more on the go forward. So, love talking taxes and then figuring out ways to be strategic. And if you want to tip the government, by all means, but for the most part, I believe in what Tom Wheelwright says, and that the tax code is really meant for investors to, incentivize us to do what the government wants, and they lay out the path. It's up to us to interpret it and take it. So let me share my screen. We'll jump right in. I'll say as well as I go through this today, if you have any questions, feel free to use the Q&A feature, drop them in there. We're going to try to keep about 20 minutes to 25 minutes of content, and then we'll open it up to everybody on the call today, and happy to take your questions or elaborate on anything that we go into. All right, so you should be seeing my screen here in a moment. Let me know, Andy, if you would, if it pops
I
up.
see it. I see it.
Perfect. Great. So when it comes to taxes, it's really, you almost can't get around it, right? We're taxed on our active income. We're taxed on our returns and our investment accounts. Those pre-tax accounts that we build over time when we do our withdrawal strategy, we're being taxed, get taxed at the fuel pump, now goods coming into the country are being taxed. So it's really everywhere. And one of the things that I like to help my clients understand is just what's that history of taxes look like? And I'll go into that in a second, but even before there, just a quick touch, and you might have started to see this already or been on some webinars talking about the bill that was passed, the new tax legislation in July 4th of 2025 this year. But a lot of it was around taking the 2017 Tax and Jobs Act and making those decreases in taxes permanent. For any of our business owners, the extension of the qualified business income deduction of 20% is a relevant one. For a lot of real estate investors that their business is real estate, that's an important one up to a threshold. So there is a point at which that deduction phases out. Another really interesting play for anybody interested in real estate is around the extension of opportunity zones. I believe the first opportunity zone package was introduced during the Obama administration, but a lot of the legislation or a lot of the benefits were phasing out and sunsetting. And now there's going to be a rolling 10-year period of new opportunity zones introduced, which is really a great way over a journey of investing in real estate and gaining unrealized gains or appreciated value to be able to invest in an opportunity zone, and then over a 10-year period get a step up in basis, and then be able to trade out of an asset, without a long-term capital gain tax consideration. So I'm not going to go into the fine points at this point, but again, just something to plant the seed, depending on where you are with your journey. Um, Also, for anybody in a blue state, raising the salt taxes, that's the state and local taxes. This is a big one for, state of California taxes, having upwards of 40,000 of a deduction there. It's far greater than, married filing jointly couple to have a $30,000 standard deduction. We're going to expect to see a lot more folks itemize their taxes on the go forward with this. Again, subject to certain thresholds of income. Um, they made permanent the gift tax. So this is more if you're on the path of having 15 to $30 million net worth, in your journey. If you are, as a married couple, you're going to have $30 million and it's going to adjust for inflation where there is no transfer tax. So on a household making, call it, or that, ends their journey with $60 million, they'd have $30 million exemption. So they've got 30 million that hits that 40% transfer tax. That's a $12 million tax bill right there. That was set to be cut in half. So positive for the very affluent, that got extended. So if that's you, that's a good thing. They really opened up the opportunities in 529 plans, which was interesting. So continuing education credits, if you're planning to get your real estate license and you have an old 529, you could actually use the funds for that. So that could potentially be interesting to this group. There's a new child savings account. Not as relevant. And I think the big one that if you're on this call, I'm sure you've heard about, but bonus depreciation being made a permanent fixture, at least, with the current administration and subject to future policy changes, that's huge, right? Because with bonus depreciation and a cost seg study, specifically, if you or your partner is designated as a real estate professional, you can let the government kind of ride along and give you massive tax breaks to be able to make your investments into real estate, do a cost seg study, get 100% accelerated bonus depreciation. You'll have massive write-offs, reducing the taxable liability on your active income. So very, very big. Obviously, consult with your CPA if there's a route for that. But that's definitely an area that is exciting for real estate investors, especially as we're expecting kind of the new launch of lower interest rates, which means real estate is definitely a place to be keeping your eye towards. Andy, feel free if there's anything that jumps out to you that you think I should clarify. Otherwise, I'm just going to run through. So I love to just take a second and walk you through the history of where income tax rates have been for the top marginal tax brackets. This is at the federal level. But what you're looking at here is prior to 1913, and this is where the administration says, hey, at one point there was no income tax. Let's go back to a more of a tariff-driven tax environment. It was illegal to garnish the U.S. population's wages and pay your income taxes first, which most of us or anybody that's got a W-2 would be familiar with. And the promise was initially, hey, we're going to start this tax, but it's going to be relatively low. Well, what happened is World War I created a massive need for funding, right, to finance a war, and taxes went up north of 70%. And the promise at that point is like, don't worry about it. When the war is over, we're going to drop it back down. Well, that was partly true, settled at around 25%. And then World War II, the Great Depression, created a period of time where if you just draw across, the top federal tax bracket was north of 60% and at its highest above 90%. So relative to where we are today, and especially with this new bill passed, right, on around a 37% highest federal marginal tax bracket, we're in a relatively good tax situation. And so one of the things is just being smart about the types of investments that we make, where we're not going to be subject to income taxes in the future when potentially we avoid a tax. If I'm talking about like an IRA, pre-tax 401k, we wouldn't want to avoid a tax necessarily when the rates are historically low, just to graduate into our retirement phase and have those balloon on us and then realize, wait a minute, I had a silent partner in the account. They adjusted their sort of ownership piece and clawed back a lot of that growth and risk that we took as individuals in the market to get that growth. So I find that's an area of most interest for a lot of people, and it's helped to have a historical view on where that's been in the past. I won't spend as much time on it, but on that transfer tax that I was talking about before, again, this is an estate tax when your net worth is over a certain limit. There's two things going on here. This chart dates back to 1916. You'll see that it started really, really low, around 50,000. So basically, if you had 50,000 or more, you were paying some kind of transfer tax. Went up to 25%, up to 40, down to 20. During that same high period, right, 77% for quite a while, and then it's been sort of drifting down for a good period of time since about the mid 70s. There was a year around 2010 where Congress just didn't have their act together, and there was no transfer tax. So I guess if you're a state planning attorney, it was a good time to have people make their exits. Just kidding. Say that tongue in cheek. And then the bars here in light blue, that's showing that general exemption that I talked about, which is now set at around 15 million. This chart's a little bit, when you adjust for inflation, is about 15 million per person in a household. So relatively high on that exemption level, and then relatively low on the overall exemption tax, meaning it's very, very affluent are the ones that are looking at that. And if you know somebody in that, that's a concern for, happy to talk to them about, strategies to reduce their estate ahead of that and, skip generations and preserve the wealth of the family. Why I think this is really important to pay attention to. The US deficit is something like $37 trillion, absolutely ballooned through the COVID era. It's been running away. And with this higher interest rate environment that kicked off in 2022 when the Fed started fighting inflation, what we know is that our interest carry as a nation had been around 250, $300 billion for quite a while. And over the last few years, with that rising interest rate environment and that ballooning deficit, it's spiraling out of control, which is why with the last administration change, a lot of the narrative was around reining in spending, right? Think of the DOGE program, which I guess at this point would have to be considered almost a complete failure. I'm not trying to make a political comment, but I haven't heard about it in months. And there's a lot of talk around reducing interest rates. You're seeing that with different conversations with the Fed and certainly the data as of this morning with the BLS report and 911,000 jobs disappearing, with the inflation core CPI coming down, almost certainly locks in at least a 25 basis point cut for the Fed funds rate coming up, if not 50. But we're certainly seeing that the federal government would like to see overall interest rates drop so that they can refinance debt and start to cap this. But this is the kind of wall that we're facing, which is why I'd rather taxes be done out of the way as a whole, or you find ways around it, you leveraging things like rep status and bonus depreciation and things like that. Again, think through your questions and comments. Happy to think through individual situations or break this down further for anybody that'd be helpful with. As far as our investment journey and just understanding taxes, I think one of the frameworks that's helpful to understand is that there's a firewall between the different ways that we can make income, right? So when you trade your time for dollars, tend to call that active income. That's the tax rates that we're looking at when I was talking about the top federal tax brackets. Um, Generally, trading time for dollars, as you make more money, you're spending a lot of money in taxes. Portfolio income is more of your non-qualified, non-retirement account investment accounts. So we've got a lot more control of our tax environment. In general, when your money is making the return for you, it's more tax efficient, namely because you can time when you make a sale, like you realize a tax. Also, you're only being taxed on your gains, right? They're short or long-term capital gains, depending on the time frame that you held the asset. And you can do strategic things like my firm will look at tax loss harvesting or never selling, but just leveraging the portfolio to be able to create liquidity. So there's ways to control the timing and the amount of your taxes if you're strategic with portfolio income. And then as real estate investors, we're looking to build passive income. And the beauty with passive income is that it can be tax-free, technically tax-deferred income, if we have enough offsetting depreciation to mitigate the income that we are receiving. So, like I said, there's a firewall. So if we think of this little white bar between all types of income, passive losses, right, with your passive income, even if you're making a net positive return, generally can't affect your tax brackets with your active income because of passive tax limitations on active income, unless your CPA agrees that you meet the criteria of being a full-time real estate professional, otherwise known as rep status. And so that's a massive, massive opportunity, specifically paired with bonus depreciation, to take passive losses, jump that firewall that I was talking about, and actually create less taxes on your active income, which just means more capital available to make strategic investments and build your wealth and build your cash flow. From a tax perspective as well, states all have their own rules. Some have income tax, some don't. The thing for California, I like to point out, because we might have some folks from California, is that while long-term capital gains tax is federally, the top rate is 20%. Most people are in a 15%. The lowest is a 0% tax bracket. California just considers any gains income tax, and it follows the tax brackets here. So if you're married filing jointly and you're making, let's say 500K, you're going to fill up these buckets and be somewhere in call it a 6.5% effective state income tax rate. On a federal level, right, the brackets are laid out here. Again, the top bracket is 37%. And the number one thing that I see people have a misunderstanding around is this concept, and I'll just share it in case this is you, where somebody might be making, let's say, they're on pace to make $205,000, and they're kind of filling up this 22% tax bracket as a married couple. And then they get a promotion to go to 210, and they're afraid because if they get to 210, now they're taxed at 24%. If you took 24% off of the full 210, they'd actually have less money. Well, that's just not how it works. The way it works is everybody's first 23 grand in that tranche is taxed at 10%. So 10% times 23 grand is your tax liability, $2,385. Then you go to the 12% bracket, take 96,000 minus the 23,000, multiply that by a rate. That's how much that tranche of your income gets taxed. And then you go all the way down the brackets, and then you take out your deductions, your child tax credits, etc. And then you figure out your adjusted gross income, and then you pay taxes accordingly. But that's the number one thing I see people miss. And again, the beauty is with cost seg studies and reps status, the idea is to maybe make 500 or 700,000, but only pay taxes on as if you're making 200,000 because you've got passive losses offsetting that active income. It can be massive, massive implications to dropping your tax liability. I kind of jumped ahead. I talked about this already. But again, if you're married filing jointly and you're making less than $50,000 a year, you don't pay long-term capital gains tax. Your rate is zero. Most folks, I'd say, are in this bracket where they're paying 15%, and anybody making more than 300,000 a year, oh, you get to keep less of your gains in the market. Why? I don't know, but that's just how it is. The other thing that I think is helpful, and this is, for anybody that's, a W-2 or a business owner and has a mixture of investments that are outside of retirement accounts, investments that are inside of retirement accounts, is just understanding that there are generally three phases of taxation. So you can think of, hey, what's happening at the contribution level, right? Is it an after-tax contribution, or is this contribution dropping my adjusted gross income? Then during the accumulation phase, right, during the holding period of that investment, is it tax deferred? Is it taxable? When's it taxable? Just understanding, how that works. And then at distribution, right? Is it tax-free, tax advantage, taxable? Are there ways to mitigate that? So a great example of this is most of the time we're making investments into real estate. We could do it one of two ways, right? We could do it in a self-directed IRA, right? And now it's, we funded that IRA with pre-tax dollars, and then it's, our distributions and gains in the account are tax deferred until we start take distributions from that account in the future, and then all of a sudden it's taxable, right? Or if we had a self-directed Roth IRA, and let's say we invested, $250,000 with Break-A-Day Capital, after tax dollars went in, so initially there wasn't any tax break on the money, but it's still earning distributions, being able to, have a refinancing activity, create a liquidity event, or maybe the investment comes full term and they sell, right? And you get a lump sum of money. As long as you're not taking money out of the account, it's still tax deferred. And the beauty of it being in Roth, eventually at some point you do start living off of some of that account. Well, now it's tax free. And regardless of what the future administrations do around taxes, you'll never have to pay taxes on it. So just different ways to look at it, but I think it's healthy to understand full cycle what that tax situation on any given investment would do. Yeah, as far as one of the exercises I'll do with clients a lot of times is just put their balance sheet in context of all the different types of accounts that they could invest in, and then really think through, again, those three phases of taxes, and then also think through which ones of these assets have volatility, meaning they move up and down, and which ones are more guaranteed or more certain. So at the top, we've got concentrated assets. That's things like equity in your personal home. That's things like the equity inside your non-qualified real estate portfolio. Deferred annuities, that's just a way of putting money into something that has the option to annuitize. Typically, that looks like an investment account with a right to create a fixed income for life at a future point. Non-qualified accounts, this is your Robinhood, Charles Schwab, Merrill Edge account that you might do some trading in. Maybe you're doing a general VTSAX and buying indexes, but it's not tied to retirement. It's more of a liquidity pool to use later. Qualified accounts, those are your pre-tax accounts. You get a deduction on the front end, but not as tax efficient in the long run. Also, qualified accounts have something called RMDs. So at some point in the future, the government tells you how much you have to take out per year. And when they do that, the unfortunate thing is you might need to take so much out that it's creating this really big tax burden, which is then quickly liquidating the account. And so I know some people that raise money for nonprofits, and their whole target is people with large pre-tax accounts that are going to give the money to a charity instead of giving it to the government. because they did so well in their retirement, and now the government is asking for theirs, right? Um, but again, these qualified accounts, your top marginal tax bracket is 37% as of now. Add on a state like California, add another 13%, that's 50%. Whereas a Roth, everything comes out tax free. So one easy strategy, just kind of looking at the top here, is to say, well, if we had 50% of our accounts in pre-tax accounts and 50% in Roth in any given year, if you need 200K of income out of the Roth, you might just take 100 grand out because there's no tax liability. You get the 100 grand. In the qualified account, you're going to get 100 grand, you might need to take 150 or 170 grand out, pay your taxes, and then net the 100. So by blending the two, you can really manipulate and strategically limit the tax liability through your retirement. And then on the left here, we've got all the fixed income streams. So pensions, not as many folks have these now, but pensions are awesome. They can be layered on as a lifetime, you can't outlive it, stream of income, hopefully indexed to inflation. Social Security, my guess is will be available for us, but it might look a little bit different. But as of right now in the, 2034, 2035, it's an unfunded liability. So some changes will need to be made in some way. And then you've got rental income, which is variable. So one really nice way to build out a retirement plan is just to have your real estate investments spit off enough passive income to cover all your current monthly expenses, and then you're out of the rat race, right? As Robert Kiyosaki would say. So I personally like a combination because it hedges my bets and it gives me the most optionality. I certainly know a lot of successful people. It's all they do is real estate, and I know a lot of successful people. All they do is sort of your traditional financial, investment accounts. I think the best way is just marrying the two and blending. But again, happy to walk through that. And the goal is at some point you turn on all these spigots, create enough cash to live on indefinitely and never have the fear of running out of money. But certainly taxes should be thought of as a big, big piece of that. For our entrepreneurs, and then I'm going to kind of wind things down, couple tax strategies that I find are awesome are listed here. One is the Augusta rule. I'm not a CPA by trade, so again, anything I'm talking about, please take to your CPA. But this should give you a good understanding of some of the parameters to be able to see if it's fitting for reducing your current tax liability. But I run a business. I've got my own P&L. I've got employees. So one of the things that I'll do with my team is instead of doing a retreat like on a monthly or quarterly basis and going to a hotel and renting out a room and paying a couple grand, for food and that space, I'll use my house. And what the Augusta rule says is I can rent my house to my business for up to 14 days. It's got to, I've got to make sure it makes business sense and it's not like, I'm charging some outrageous fee, right? It's like, commiserate with what the market would be. But what I'm able to do is essentially for those 14 days of income I'm receiving on my, personal tax situation, I don't have to report it if it's under 14 days. And I'm creating a business expense for the pursuit of, growing and investing in my team, that I'm the receiver of that income, right? So it's perfect. It's, businesses pay taxes. It's revenue minus expenses equals profit. That's what we get taxed on. And what I'm doing is I'm increasing the expenses, but it's paying me, right, as the person renting my primary residence to the business. And then I don't have to report it because I'm keeping it under 14 days. So that's the Augusta rule. You could easily have, 15K a year of additional write-offs from the business, fully above board, backed by, the Augusta is literally was created through Section 280A. So that's a great one. Another one is, in my social media, My kids are essentially models. I've got three awesome daughters. They're 3, 5, and 8. And I'll pay them, a small modeling fee, which again creates a expense for my business, and I use their images in marketing and things like that. Um, but what happens on their end is now they've got some income, so I could fund a Roth IRA for them, or I could pay for their activities essentially with pre-tax dollars, right? So there's different ways to, again, structure things and talk to your CPA. And then the last one's the Section 179 write-off. So this is if you buy a large enough SUV or a pickup truck and you're able to take 100% bonus depreciation and work that off against your active income as a business owner. So those are three really cool, easy opportunities for potentially some of us on the call. Um, the other strategy that I'm a big fan of, and I think every real estate investor sort of comes to this over time, is the idea of buying an asset, harvesting the equity in that asset over time, so we can maintain control of the asset, but we harvest equity in it by creating an extra lien or collateralizing that asset. And then eventually, when we pass, those assets get what's called a step up in basis. And then our kids could decide, hey, do we want to sell this asset, pay no capital gains tax, and redistribute it, or do whatever they want. But it eliminates all those, kicking the can down the road and controlling again the timing and when we're paying taxes. So really, really cool strategy. I'll highlight a couple areas where we can use that. So inside of real estate, my own story, I'll share a little bit. Initially, I bought a house in 2013 in the Bay Area. I paid about 600,000 for it. A few years later, it had gone up in value. I took out a HELOC, so I didn't sell the house. I didn't create a capital gain, but I took out a $200,000 HELOC that allowed me to buy a house down the street for a great opportunity because it was in some distress. So none of my own money, right? I paid for the deal with a line of credit and uh 75% financing from a bank, and had a second property. And our initial goal was to move into that property and then rent the other one because rents had risen over that amount of time and could cover the old mortgage. And then what happened is, that second house was at 755 outside of the pandemic. Now house one is worth 1.5. It's gone up almost 900,000. House two is now worth 1.3. It's almost not quite doubled in value, but made some major moves. And then the interest rate environment all of a sudden is dirt cheap, right? We hit this, sub 3% interest rate environments. I actually moved to Southern California, did a double cash out refi. I had, also stabilized both properties with renters. And now all of a sudden I had, 350, 400,000 of cash in my checking account that I didn't pay any taxes on. And I was able to start buying properties in Texas, which is where I was seeing people leaving LA from and moving towards. So great way to continue to harvest my equity, build my portfolio, create a lot of optionality in our lives without having to be confronted with any kind of tax bill, right? A lot of my clients with a big investment account, let's say they've got $1 million invested with us, we'll put a security backed line of credit on that. They can get up to $650,000 on that line. And strategically, they'll use a piece of that liquidity to make investments, whether that's adding an ADU on a property or into a syndication that is promising, and really control two assets and avoid taxes, right? You can do this in properly designed and structured cash value life insurance. You could do it with gold at a gold vault. There's a lot of ways to do it, but I'm a big fan of controlling your tax destiny and also weaponizing or daisy chaining your balance sheet to have more liquidity, to make more investments. And in general, if the government keeps printing money and there's an emphasis on lowering rates, money, there's going to be more money in circulation that can compete over these assets that will then drive up prices and drive up your net worth. So That said, I know that's been a lot. I'd love to open it up for Q&A. I will say, one thing that I am offering anybody that hopped on the call today, if any of this has been interesting or you'd like to see, hey, if we're in your shoes with your balance sheet, income and expenses and your goals and time horizons, what would we be doing to affect an improved outcome? Happy to walk you through our process complimentary. And just wanted to thank the Break a Day Capital folks for the opportunity to be with you all today.
And while we wait for Q&A, I'll just the ball started. So we have a lot of investors where bonus depreciation is really important to them. But also we have some newer investors that aren't as familiar with the concept. Maybe if you just take a deeper dive and talk about bonus depreciation and how it relates to real estate investing, especially passive real estate investing.
Yeah, absolutely. So, it's really bonus depreciation combined with something called a cost segregation study. And it's the concept here is that whether it's a commercial property or a single family home, you can have straight line depreciation, which means you're dividing the improved value of the land, right? So X land, but the sticks, bricks, and mechanicals, et cetera, over a 27 and a half, or commercial, I believe, is 29. You might have that better than me, Andy.
Um, I think it's 2020. I'm pretty sure it's 2029.
It was 29 years or something along
Oh,
those lines.
I thought it was 27 and a half years. I thought it was.
Single family homes are commercials
Yeah.
longer.
Okay.
But you divide the improved value of the land by 27 and a half in a single family home example, because that's what I personally own the most of. And that creates a depreciation schedule. And if you have CapEx improvements, you can add to that. But you're taking it over a very long period of time. So it's a much smaller passive loss that you're showing on your P&L for your property every year. With a cost seg study, what you're doing is you're having somebody that's certified go and say, well, not all of the inputs or improvements on the house are going to depreciate over that long of a time table. So maybe the roof is 27 and a half years, but certainly the mechanical might be more like 5 years, right? Or the dishwasher and the refrigerators might be, 5 years. So what they do is they kind of break the home into all its various components and its own depreciation tables and gives you and front loads how much depreciation you can claim in year one, two, three, four, five. Now, if you take it all up front and with 100% bonus depreciation, you get to take it all in year one. The beauty is, specifically with rep status, you can really affect your active income that way, or you can make a massive loss and then do a carry forward going forward. Just know that you are accelerating it, so you're moving it forward. So in the later years, you wouldn't necessarily have that available. But there's always things you can do to mitigate things like 1031 exchanges to continue to kick the can down the road, or just the borrow, die strategy, and eventually your kids get a step up in basis and kind of eliminate that depreciation from your gains and your taxes.
So maybe for an investor that invests, for example, with Break a Day Capital, and we give quarterly distributions, those would be offset by bonus depreciation losses, right?
Exactly, yeah. And so that's the beauty is really with passive income is keeping it very tax free, right? Because it's nice to stack an additional layer of income that we don't have to address taxes on, and the bonus depreciation absolutely offsets that. I mean, I can tell you, firsthand, a lot of my clients that are interested in real estate are interested in it. The primary vehicle for the return is the tax savings, right? And then it's, appreciation, forcing the appreciation. It's what you're able to do, improving net operating income, applied to a cap rate and kind of, general rule of thumb, if the exit cap rate is 20, well, for every dollar of net operating income, sorry, is 4% cap rate on the exit, for every dollar, you're getting $25 worth of value, right? If it's a 5% cap, you're getting, for every dollar of net operating income, you're getting, what would that be? You're getting $20, right? So if it's an eight, right, you would just follow that logic, but you're getting a multiple for every dollar. That's the cool thing. So small, measured improvements spread over a lot of units makes a big, big impact.
Right. We have a question from the audience. So for the buy, borrow, and die strategy, how important is it to have a trust to use for the investing portion?
I mean, the trust, it's not necessarily well, here's where the trust's very important, especially if it's real estate and especially if it's in a state like California, is what you're using the trust for is to avoid probate. And probate is just the strategy works either way as far as getting a step up in basis. But if you don't have a trust, then your estate needs to go through a public affair essentially to figure out who gets the assets. And there could be parties that come in and say, "Hey, I have a claim." If it's my estate, Bromley promised me, it's a third cousin or something that I would get it, right? And now they're fighting it out. And so there's attorney's fees, there's a fee just, to hold the trial to begin with. So it elongates things and, best practice have at very minimum, if you own real estate, you should have a living will and a trust. But it's not necessarily for the strategy to work. It's more to avoid probate and sort of, having your estate decided in a public affair out in the open, with a lot of added fees that your estate, that's going to just reduce your estate that goes to your beneficiary.
Got it. And let's see. I think that's the only other question we had today. So unless anyone had any last minute questions, let's give it a second. Okay. Well, thank you, Bromley, for sharing those insights, and thanks for sharing your personal story. And thanks for everyone's time for joining us today. So we hope you found this session helpful. It was hopefully Bromley was able to share some insights to help build passive wealth through passive investing. So if you'd like to continue the conversation or learn more about our current opportunities at Break a Day Capital, feel free to reach out to me directly at andy@breakadaycapital.com. We'll also share follow-up email resources from today's session. Bromley, if you wanted to finally share your contact information if people want to reach out to you directly.
Yeah, what's the best way to do that through the chat here?
Yeah, maybe if you just verbally say it out, we can put it into the chat as well.
Yeah, if you want to reach out to me, I'll give you my cell. It's 510-295-3562, or my work email is Bromley, Bromley .palamountain, PALAMOUNTAIN @nm, like Nancy Mary.com.
Great. All right, thanks everyone. Thanks for your time. Thanks, Bromley.
Thank you.
Have a good night. Bye.